All right, let's talk about building an investment portfolio. If you've ever felt like you're trying to solve some crazy complex puzzle with half the pieces missing, you are definitely not alone. But what if I told you that you can go from total confusion to real confidence just by using a few key principles and strategies? So let's jump in and start building that roadmap to your financial future, piece by piece.
So here's what we're going to cover. First up, we'll nail down the absolute golden rules of investing. Then we'll look at some super simple portfolios you could literally start with today. From there, we'll talk about how to tailor your investments for your age, explore some smarter strategies, and then we'll finish with the real secret sauce, how to stay the course for the long haul. Okay, let's kick things off with Section 1, Investing's Golden Rules. Seriously, these are the foundations. Get these right, and you're already way ahead of the game.
This is the big question, isn't it? The amount of information out there can feel, well, just overwhelming. You've got charts and jargon and experts yelling at you from every corner. But what if I told you that a powerful investment strategy doesn't need to be that complicated? The secret is actually just sticking to a few simple, timeless principles.
And here they are, the three big ones. First, just start. Today, right now. Even a small amount can grow into something huge over time, thanks to the magic of compounding. Second, and this is so important, it's about time in the market, not timing the market. And that leads right into number 3. Trying to predict the market's ups and downs is basically a fool's errand. Seriously, don't even try. Consistency is your real superpower here, not a crystal ball.
Okay, so with those rules as our bedrock, let's shift gears from the why to the how. Section 2 is all about simple, practical portfolios you can actually use. No PhD in finance required, I promise.
Let's start with a classic rule of thumb called the Rule of 110. It's a beautifully simple way to get a rough idea of your stock allocation. You just take the number 110, subtract your age, and boom, that's the percentage you should probably have in stocks. The idea is simple. The younger you are, the more time you have to bounce back from any market downturns, so you can afford to take more risk. The rest of your money would then go into safer things like bonds.
So let's see how this works in the real world. Say you're 30 years old. You take 110 minus 30, and you get 80. So according to this rule, about 80% of your portfolio should be in stocks. Simple as that. It's a great starting point.
Now here's another absolute legend in the investing world, the 60-40 portfolio. It's been the foundation of balanced investing for, ever. You put 60% of your money in stocks for that long-term growth and 40% in bonds for stability. The bonds are there to act as a cushion. When the stock market gets choppy and goes down, high-quality bonds often hold steady or even go up, which helps smooth out the ride.
And you don't have to take my word for it. Just look at the long-term power of this strategy. These numbers are incredible. We're talking about returns of nearly 5% a year after you account for inflation in places like the US and Australia. And that's over more than 100 years. That is some serious time-tested consistency. Okay, simple rules are a fantastic place to start, but your strategy shouldn't be set in stone forever. It needs to grow and change as you do. So in Section 3, let's get into how to fine-tune your portfolio based on where you are in life.
This is a concept called the investment glide path. It's the same logic that target date funds use. See how it works? When you're young, maybe 25, your portfolio is super aggressive, like 90% stocks, because you have decades ahead of you. But as you get closer to needing that money, say at age 65, your mix glides toward a more conservative, 50-50 split. The goal totally shifts from pedal to the metal growth to protecting the nest egg you've worked so hard to build.
All right, so for those of you who want to get a little more hands-on and have a bit more control, let's dive into Section 4, Smarter Portfolio Strategies.
First up is what's called the core satellite approach. I love this one. Think of it like building your own little solar system. In the center, you have your core. This is your big, stable sun made up of broad, low-cost index funds. Then, orbiting around it, you have your smaller satellites. These are your more focused bets on specific stocks or exciting themes where you're hoping to get some extra growth.
And here's what that might look like. You could put, say, 80% of your portfolio into that solid, reliable core. That's your anchor. It keeps you grounded. The other 20% is your satellite portion. That's your fun money, where you can take some calculated risks in areas you're really passionate about, maybe things like AI or green energy, without betting the entire farm.
Next up is a slightly more advanced idea, factor investing. Now, stick with me here. It's actually pretty cool. Think of it like this. When you're booking a hotel, you don't just look at every single hotel in the city, right? You use filters. You might filter for beachfront or free breakfast. Well, factor investing is basically doing the same thing with stocks.
Instead of just buying the whole market, you filter for specific traits or factors that have historically led to better returns. You might filter for value stocks, companies that look cheap, or maybe quality stocks, which are companies with rock-solid finances.
Okay, building the portfolio is one thing, but honestly, it's only half the battle. The place where people really succeed or fail is in managing their own behavior over time. And that brings us to our final and probably most important section, staying the course.
So let's talk about something called portfolio drift and why rebalancing is so critical. This example is just perfect. Look at portfolio A on the left. It started out as a nice, balanced 50-50 mix. But after 12 years of stocks doing really well, it drifted all the way to a much riskier 78% stock portfolio. It's totally out of whack. Now look at portfolio B. By rebalancing regularly, it stayed right on target at 50-50. This one simple habit keeps you from accidentally taking on way more risk than you're comfortable with.
And what about trying to be a genius and constantly pick winning stocks? Well, the data offers a pretty sobering reality check. This table compares professional fund managers against simple passive index funds. Just look at those 15-year numbers. In the US, over 92% of active managers failed to beat their benchmark. 92%. The data is just crystal clear. For most people, even the pros, trying to outsmart the market over the long term is a losing game.
And hey, that's not just my opinion. The report itself puts it as bluntly as possible. It says most institutional managers underperform most of the time. The tendency for underperformance typically rises as the observation period lengthens. It's just a powerful, powerful reminder that simple and steady really does win the race.
So as we wrap things up here, I want to leave you with this one final thought. Your portfolio isn't just a spreadsheet with a bunch of numbers. It's the engine that's going to power your future, your goals, your dreams. So after everything we've talked about today, from the simple rules to the smarter strategies, just take a minute and ask yourself, is the story your portfolio is telling today the one you really want for your future?